This is when silver and gold will boom. So gold to $4,575 and silver to $52.77. Now, you're probably wondering, Steve, how the heck did you come up with these numbers? Well, I'm going to explain exactly how I got these numbers towards the end of this video, but you've got to stay with me to understand why I get to this position. So I've done this video before, property crash 25% this year. For my Australian viewers, if you haven't watched it, you have to go watch it. I'm telling you, go watch it, because yes, the gold price involves what's going to happen to Australian property this year. Now, I also did this video, housing to crash 73%. I would recommend watch the other one rather than this one. The other one was full of and I think it goes for about 40 odd minutes. It's got a lot of data and a lot of information. And in this video, I'm going to share a little bit more information with you, and you'll see where I'm getting to, why I've come up with that gold and silver price. And coming in from Daniel Lacaille, is the global housing bubble bursting? Australia, Scandinavia, and Canada appear to be prone to greater downside risk, while the Eurozone and the US are relatively better positioned. And from Macquarie Research, this chart shows why Australia has a much greater problem with potential housing crash than even Canada. And I've shared charts similar to this in previous videos on housing, on Aussie housing, where almost 2/3 of all bank lending is for housing. So the banks have betted big on housing. This compares with just 30% in the US and 40% in Canada. So in those previous videos on housing I shared some of the data that we're seeing with house prices in New Zealand and how much they've fallen so far this year. And you can see from this chart, both national excluding Auckland and Wellington are actually falling faster in the first 6 months than the first 6 months of the US housing crash. And data that we're seeing is that Sydney is currently on the same trajectory as Auckland. And I'm also hearing out of Wellington that real estate agents are saying that people are reducing their asking price by 20-25% already. And here from Noel Whittaker, one of Australia's most respected financial advisors over a long period of time, reporting that Westpac says second fastest tightening cycle in 30 years, which will bring rates to 2.6% by the year's end. Fasten your seatbelt. So they're actually saying that the RBA will raise rates 50 basis points in the next 2 months and get to 2.6%. We'll have a look at what the futures market are predicting shortly. And a tweet from David Taylor. He says, big call from Deutsche Bank. It's calling an Australian recession in 2023 based on its forecast of RBA rate, cash rate reaching 3.1% by the end of this year, and that producing a spike in the unemployment of 1% by the end of 2023. And here from the Daily Mail, Australia's most powerful banker issues a chilling warning to homeowners to be prepared for more interest rate pain, and it could last for years. It will start to bite. And here from the Fin Review, Aussie house price could fall more than 30% using the RBA's own modelling. And here also from the Fin Review, weaker housing, Morgan Stanley slashes bank valuations. And just declaring an interest here, we do have short positions on the banks. We've had them for a little while now, and those positions are actually looking quite good. And I've shared in other videos that we do have short positions on some other iron ore stocks and whatnot. And we have nervous vendors retreat from auctions. In Sydney, 28% of scheduled auctions were withdrawn, the highest rate since April 2020, when fear was everywhere. where everyone, including the banks, thought that we were going to see a 32% fall in housing. Now, the Reserve Bank of Australia Governor Philip Lowe said that CPI will hit around 7%. However, our new Treasurer, Jim Chalmers, is warning of significantly higher inflation, or CPI, than what the RBA Governor is saying. So here from news.com.au, Russ Stevens, co-founder of the Association of Professional Builders, has estimated around 50% of Australian building companies are currently trading insolvent, which means they can't pay their bills. National Australia Bank Chief Executive Ross McEwen, now NAB is our largest business loan lender in Australia, has said construction was the most worrying sector for the bank's loan book. Now, we're seeing every week on the news builders going under. And why is this worrying or worrisome for the Australian economy? Well, the Australian housing sector, and I've said this many times before in other property videos, is that the construction sector employs around 11 to 12% of all Australians. So that's a massive, in fact, it's the largest single sector of employment in the country. Now, you can believe the ABS unemployment numbers of 3.9%. However, I like to use Roy Morgan's, and their latest data is at 8.1%. Now, if we see a lot of builders going under, and personally, there's some builders in my building where I'm at, and those builders have closed down one of their arms, which is the cheaper homes, and they told us there's less margin in that stuff. Where they've got downstairs, they've got a high-end housing business where they do $1 to $2 million homes. So you can see here household debt to GDP ratios, which is the end of last year. Australia, we're just behind Switzerland in second place, 119%. You can see Canada, 108%. United States, 78% in 13th. But good old, where are they? Ireland in 40th. They've learnt their lesson. They're at 30% debt to GDP. They had some pain. They learnt their lesson. So with all of this, the latest mortgage stress numbers from Martin North from Digital Finance Analytics has mortgage stress, which is measured on a cash flow basis, so cash flow in versus cash flow out, meaning 43 is now 43%. So 43% of all mortgage holders have a cash flow problem, meaning they have more cash flow going out than they've got cash flow coming in. And from the boys from Macro Business, Aussie first home buyers are about to get slaughtered. It's funny, in 2020, my business partner and I were in the office, and when the government announced all these home buyer grants and take, up to $40,000 if you're a couple out of your retirement savings to put, most of them put it towards a house. We had clients, we had first home buyers who had no savings. All of a sudden they had $85,000 deposit from all the government grants to buy a house. And then obviously no one was forced to sell their house. Everyone was able to get mortgage repayment holidays and deferrals and whatnot. And so there was no forced supply onto the market. At the same time, the government created huge amounts of demand from those incentives. Then we had all sorts of different government grants, both at the federal and state level. Then we also had the RBA lowering rates to 0.1%, giving the banks a $200 billion term funding facility, which, by the way, rolls off soon. I think, next year and the year after, it rolls off. So, yeah, the bank's funding costs are going to rise significantly because of that. But, then we had FOMO. FOMO kicked in, and wow, it's amazing how just recently that FOMO is now changing, and people are now starting to be scared. People wanting to pull out of purchase contracts. So it's interesting how FOMO, fear of missing out, but now this fear of losing, is starting to kick in. So this is also interesting. So if you look at the deposit amount and percentage of first home buyers, you can see that 49% of first home buyers had less than 10% deposit, or 91% had less than 20% deposit. Also reflected the number of debt to income ratio loans above 6. You can see down the bottom that it has been significantly rising throughout 2020 and into 2021, as government's created all this demand and pulled all this demand forward. And APRA, our prudential regulator, says that mortgages above 6 times debt to income are very highly risk. They're high risk loans of default. Now, with mortgage rates projected to hit 6 to 7% next year, recent first home buyers are facing huge rises in mortgage repayments at the same time as the value of their homes are falling, which could put many into negative territory and become mortgage prisoners. In fact, I've said that term mortgage prisoners is going to be, a meme, or it's going to become very well known over the next couple of years. Mortgage prisoners, because people won't be able to refinance. They're coming off. So, we had people in Australia, we have 1 to 5 year fixed rates. Predominantly, the most common one is a 3-year fixed rate, with the second most common being a 2-year fixed rate. And a lot of people locked in rates at 1.89, 1.99, and they're going to roll off over the next, into next year and into 2024, and they're going to be looking at 6 and 7% interest mortgage rates. ANZ just last week raised their fixed rates by 0.9%. And actually, we got a client, the last client that we had that locked in at a 1.99 fixed rate. We worked out their servicing capacity, and it was just over $1 million. I think from memory, it was $1,080,000 was their borrowing capacity. Now, we worked out their borrowing capacity if they took out a fixed rate at 5.99 today, which is where some of the fixed rates are. 5.99, their borrowing capacity drops down to 670,000. So from $1,080,000, their maximum borrowing capacity drops down to 670,000. And this is the thing. This is going to impact what people can buy moving forward. Is their purchasing power is going to be severely reduced as interest rates rise. And as I said, mortgage prisoners. So we're going to have people with more debt than what the value of their home is. And you know what? Even if they had the equity, just from a servicing capacity, they won't be able to service, so they won't be able to refinance. So they're going to be stuck no matter what. And, so when they come off these fixed rates, there's going to be a lot of people facing double or triple their mortgage rates. In fact, this chart shows it here. Shows that the growth in the amount of fixed rates. And as I said, we have 1 to 5 year fixed rates. And so you can see like 45% of people took out fixed rates. Usually throughout history, the median or mean is around 20%. In New Zealand, it's the other way. New Zealand, about 80% of their mortgages are fixed and 20% are variable, where we're 80% variable, 20% fixed. So 45% is very high for Australia. And according to CBA, the largest lender in Australia, the Commonwealth Bank of Australia, head of Australian economics, Gareth Aird, around $500 billion worth of fixed rate mortgages are due to refinance by the end of 2023, if they can. Under the Economist median interest rate forecast, the average discount variable mortgage rate will rise to around 6% by mid next year, whereas the futures market is tipping mortgages to be above 7%. If either scenario comes to pass, the pandemic fixed rate borrowers would face a tripling or more in their mortgage rates when it comes to refinance, and given Australian house prices are forecasted to fall sharply over the same period, many would also face negative equity. So here's the cash rate futures implied yield curve. Now you can see that February next year is when the futures market is predicting that the cash rate, the RBA cash rate, will be above 4%. That's February next year. That's only months away. And it'll be around 4.5% by the middle of next year. So if that plays out, then yeah, mortgage rates are going to be above 7%. Above 7%. So a lot of people are going to be coming off 1.89 and 1.99 fixed rates to paying over 7%. Remember those things called adjustable rate mortgages in the US prior to the GFC? All right, so quickly moving on as you guys want to get to the gold part and how this is all linked. So Australian new mortgages versus dwelling price growth. Now we're going to see new mortgages just crash through the floor. And you can see the good correlation here between the two. And also house prices versus consumer confidence. Good correlation there. Consumer confidence, you can see that that's falling. So we expect house prices to follow suit. In fact, if you look at the consumer confidence in blue, this is ANZ Roy Morgan, it's down to that, the peak of the cerveza sickness, if you want to put it that, the cough, where we're locking down the economy and everyone just thought, what the heck is going on? So this is not looking good. In fact, future financial conditions fell 10.1%. And I like the University of Michigan Consumer Sentiment Index. It's probably the best in the world, in my opinion. And when you see the consumer confidence down this low, it always equals a recession. So, in my opinion, a recession is baked in. Any central bankers tell you, we don't think there's going to be a recession, is lying to you. They know there's going to be a recession. All right, now we're getting to the gold part. All right, and where I got those gold and silver prices from. That's why you guys are watching this video. So in the weekend, Australian over the weekend, there was this article, The Currency Game and Why Prices Will Continue to Climb. And in it, we had this. The Commonwealth Bank, now that's Australia's largest bank, believes that the pain set to be suffered by Australians if the Reserve Bank follows the interest rate rises as being forecast in the money markets will be so great that the central bank will pull back. This makes currency markets nervous. One reason for the lower Australian dollar against the greenback is that currency markets expect the US Federal Reserve to be tough on inflation via higher interest rates, but they doubt the Australian Central Bank's interest rate resolve, partly because of the CBA warning. Now, I've just shared with you guys a whole heap of information. Australian banks have gone all in on Australian property. 2/3 of their balance sheet is leveraged to Australian property. Okay? You've seen the debt levels, the debt to GDP. I've done other videos, debt to income, you name it, everything. Everything's there. You've seen the argument. We've gone all in on property in Australia. So on FinTwit, this chart has been shared over and over and over again by everyone all around the world. The value of all residential land on household balance sheet relative to GDP. So you had Japan and you got Australia. Australia has now surpassed Japan when it comes to the value of all residential land on household balance sheets relative to GDP. And when everyone saw this, everyone's like, wow. And by the way, I'm not saying that Australian real estate is going to follow Japan. Maybe it will. Maybe it will. I'm not saying that. I'm not saying it will or it won't. But if it does, by the way, go have a look at a chart of Japanese real estate today. It hasn't got back to those levels. So everyone's like, okay, how do I short banks? How do I short Australian real estate? And then Brent Johnson, Dollar Milkshake Man, came up with this tweet. So with everyone wanting to short the banks and short the property market, sound money equals prosperity for all, sound money P. said, be careful trying to short those damn Aussie banks. I've heard the government will back them for forever. No idea how valid this may be. I've never tried shorting them, by the way. Now, all you guys are watching this video right now, especially if you're from Australia, will say, nah, Steve, housing cannot fall. I've heard this a million times by every so-called expert, but the government will never let it fail. The government will never let it fall. The government will step in. The RBA will step in. And you know what? Brent Johnson says true. As such, the release valve will end up being the currency. Aussie dollar going to 40. Now, we're at 69 right now, 70. He's saying sub 40. Now, that's the thing, is we have levered our whole economy and our whole financial system here in Australia to real estate. If interest rates, like what the RBA and what the futures market is implying, I'm telling you, there is all hell is going to break loose on the Australian property market and the Australian economy. And so I definitely see, compared to the US, I see Australia, the RBA, just dropping this rate rise and just saying, nah, we give up. Inflation, you win. Because what will happen is banks will start to fail here in Australia. And the RBA are going to have to come in and do something to bail them out. And Lindsay David, an Australian economist, has done some tremendous work on this. So I recommend you guys follow Lindsay David, read his book, read his work. He's done a lot of work on this, and he very much agrees with Brent Johnson that the RBA and the government are going to have to step in and do something to save the banks. But at that point, the release valve will be the currency. And so the Aussie dollar is going to 40. And if that happens, well, guess what's going to happen to inflation and CPI in Australia? It's going up. It's going up, and we're going to have a big problem with our currency. So go have a look at a chart of gold in Japanese yen and have a look at how well that's done because of what's happened to the yen. And basically, how I got that figure of $4,575 gold and $52.77 silver is just taking today's price of $18.30 gold and $21.11 silver and converting it to an Aussie dollar at 40. And that's where we get that number. 4,575 for gold and 52.77 for silver. Now, you know, this is the whole dollar milkshake theory, and this is one reason why I own both gold and silver, why I own commodities, and why I have a percentage of my portfolio in US dollars. Because Brent Johnson's theory makes a lot of sense to me. And you know what? If it's wrong and the Aussie skyrockets and you know gold skyrockets because the US goes into hyperinflation, well, guess what? I do well anyway. I do well both ways, no matter what happens. However, with this, I'll convert those US dollars into Australian dollars. And, well, what will I buy? Well, there's a lot of things. There's a lot of quality Australian miners and explorers. There's a lot of value stocks that pay high dividends where I can use options to generate premium, which I use to compound and accumulate more assets. So if you think the Australian government is going to protect Australian property, if the RBA is going to protect the Australian property and protect banks, then the currency is going to be in big trouble. And that is good for our gold and silver holdings in Australian dollar terms. Now, you know, this is what happens when you have a fully elastic fiat system. When things get out of hand with cheap credit. And cheap credit you don't have to buy real things. And we know what happened in the late 80s in Tokyo, and you know what? The right thing to do is let the bust happen. But the question is, will they? Now, here's a chart, and now this is US centric, but this applies to Australia, applies around the world, around the Western world in particular. All sectors, debt, securities, and loans. That's the blue line. She's going up. You got GDP. Now, GDP is our income. All right, so the income, get this right, that's the income to pay that blue line. So the purple line is supposed to pay the blue line, and there's the federal funds rate. So when you think of Australian housing debt, and if central banks, the RBA, raises rates, what that's going to do in terms of the income to service the debt. So what are we going to have? A big debt deflation? The biggest depression makes the 1929, 1930s depression just look like a walk in the park? Or are we going to see central banks, in particular the RBA first, go, yeah, nah, bugger this. We're slamming the handbrake on. We're turning around. We're cutting. Well, that's my theory. That's how I think things are going to play out, and that's when I think, we'll see gold and silver and assets measured in US dollars do exceptionally well, and that's why I'm positioned that way in my portfolio, and I'm hedged. Yes, I am shorting banks because I do think there's going to be some pain in the short run, and I am shorting other metals, in particular iron ore. Anyway, what do you guys think? Love to see your thoughts and opinions in the comments below. Do you think I am wrong? Does this make sense? Do you have any questions? I've tried to explain it the best I can without writing a script, just talking, just sharing all this data, sharing it off the top of my head. And sometimes I forget things, and I like to see those comments from you guys because sometimes you pick up on things that I've failed to mention in the video. So really love to see that below. Once again, if you like this video, guys, please hit that like button. Really do appreciate it. Take care, everyone, and I'll see you all again on another episode of Finance Uncut.